Welcome to the third session in this series of webinars, which VLP is running on topics of interest to the financial services community. My name is Kate Ison and I'm a Senior Associate in the VLP Corporate Tax Group. In the next half hour or so, I'm going to give you a practical overview of a new corporate criminal offence relating to the failure to prevent the facilitation of tax evasion, which will be introduced later this year. The government's proposals on this have attracted some degree of controversy and will, without question, subject all financial institutions and the majority of corporations to additional compliance burdens. I'm first going to outline the key elements of the proposed offence in this session, and then I will talk through some of the steps which you should be taking in the immediate short term to ensure that your organisation is adequately prepared for the introduction of the new offence. As you will be aware, the tax landscape has changed significantly in recent years. Tax is now a headline issue, most recently with the release of the Panama Papers, and the lines between tax evasion and avoidance are becoming increasingly blurred. The current tax environment is marked by unprecedented cooperation between international tax authorities, in particular in relation to the exchange of information. Closer to home, HMRC has come under increasing pressure from the UK government as well as the Court of Public Opinion, to deter, investigate and prosecute tax evasion. Over the last 2 years, HMRC has launched a series of measures and consultations as part of its so-called No Safe Havens campaign, which is aimed at tackling tax evasion. Several of these are listed on the screen in front of you. By way of example, during 2015 to 16, HMRC identified 2,972 cases of serious tax evasion, and the number of criminal prosecutions for serious tax crime is expected to rise over the next 5 years by 100%. It is against this background that the government has confirmed its intention to accelerate the introduction of a new strict liability criminal offence which will apply to corporations which fail to prevent the facilitation of tax evasion. The government has stated that the purpose of the new legislation is to encourage good corporate governance and behaviour and to make it easier for corporations to be held accountable for the criminal acts of their representatives. Historically, it has been difficult for HMRC to prosecute banks or companies where their representatives facilitate tax evasion because HMRC has needed to prove that the directive mind and will of the corporation, in other words, senior management, typically at board level, were aware of or involved in the wrongdoing. This new offence is intended to overcome this hurdle because it is a strict liability offence which does not require any knowledge or intent at the corporate level, but the practical effect will be that corporations will now be required to police and monitor themselves. Although the legislation is still in draft form and subject to further consultation, we can assume that it's very close to final form. It's very clear that the offence is intended to be broad in scope and to apply in respect of both the facilitation of UK and foreign tax evasion. Although it is commonly referred to as a single offence, the government has in fact provided for two distinct offences. The first imposes criminal liability at the corporate level where the corporation in question fails to prevent the facilitation of UK tax evasion. The second offence relates to the failure to prevent the facilitation of overseas tax evasion. There are some small points of detail which differ between the two offences, but the key elements of both are the same. In each case, there are three principal elements which must be satisfied in order for the corporation to be held criminally liable. Firstly, a taxpayer must commit a tax evasion offence, and I'll come back later to talk about what this means in relation to each of the UK and overseas offences. Secondly, a person associated with the relevant body must commit a UK or foreign tax facilitation offence. And finally, the relevant body must not have had in place reasonable procedures to prevent that facilitation unless the corporation in question can demonstrate that in its particular circumstances it was reasonable not to have any such prevention procedures in place. Before I go on to talk through the detail of the specific UK and overseas offences, I would like to first pick up on two key concepts which are common to both. You'll note from the slide that the offences will apply to a relevant body. This is widely defined to cover both body corporates and partnerships. In principle, the definition will cover the full range of legal persons, from financial institutions to LLPs to small not-for-profit organisations, but it's very clear that the offence is particularly targeted at financial institutions, professional services firms, and other entities operating in the financial services sector, all of whom the government consider to face the highest degree of risk that their services may be used to facilitate the evasion of tax. The other key concept is who will be an associated person for these purposes. The definition in the draft legislation is very wide and covers a person who is providing services for or on behalf of the corporation. It will most commonly cover an employee, but it could also include an agent, a contractor, a subsidiary, or other third-party organisation providing services to a customer, for example, as part of a package provided by a bank. Whether a person is acting on behalf of the corporation is a question of substance and not form, and will be determined by reference to all relevant circumstances. Examples of persons who will not commonly be covered by the definition would be an employee advising in a private capacity and acting entirely on his own account, or a person to whom business is just referred. But again, particularly in the case of referrals, this will depend on the particular facts, including the terms of the contract between the organisation and the person to whom it refers business, and the degree of control exercised over that person by the relevant organisation. As a final point on the meaning of associated person, I should add that unlike the Bribery Act concept, for this new tax offence to bite, there is no requirement at all that the associated person facilitated the tax evasion in order to benefit the corporation. Liability at the corporate level will arise wherever the corporation fails to prevent the facilitation of tax evasion, irrespective of whether or not it gains a benefit from it. However, it's recognised and anticipated that the question of benefit may well be evidentially significant and may assist in determining whether a person was acting or providing services for or on behalf of the corporation. Given this, there are some very important practical steps which businesses should now take to identify associated persons and the terms of their engagement, and I'll come back to deal with this later. Looking now at the detail of the specific offences in turn, starting first with the failure to prevent the facilitation of UK tax evasion. This offence will apply to all corporates and partnerships, irrespective of whether they are incorporated or based in the UK or overseas, and irrespective of whether the act or omission constituting the facilitation of the UK tax evasion offence took place in the UK. The net is deliberately cast wide in order to provide HMRC with the maximum scope to tackle any UK tax loss. For the offence to be triggered, first, a taxpayer must have committed a criminal offence of evading UK tax. This predicate offence includes both the common law offence of cheating the public revenue and the offence of being knowingly concerned in or taking steps with a view to fraudulently evading UK tax. Secondly, an associated person must have criminally facilitated the evasion of UK tax by either aiding, abetting, counselling or procuring the tax evasion, or by being knowingly concerned in or taking steps with a view to the fraudulent evasion of tax by the taxpayer. During the consultation, there was a lot of comment on what will constitute facilitation. Concern was expressed that if a person acting on behalf of the corporation innocently or unknowingly facilitated tax evasion, this could nevertheless lead to criminal liability at the corporate level. This is not the case. It's very clear now that in order for the condition of criminal facilitation to be satisfied, the person committing that facilitation must have had dishonest intent to do so. Businesses can therefore take some comfort that where an individual employee acts negligently or foolishly, or is acting in good faith entirely unaware of the intentions of the taxpayer committing the evasion, he will not be guilty of a facilitation offence, and consequently there will be no criminal liability for the corporation. It is important to note, though, that this area is likely, again, to be an evidential battleground. The burden of proof will be on the prosecuting agency to prove, beyond reasonable doubt, that both the criminal offence of tax evasion and the offence of facilitation have been committed. However, the corporation may be found guilty of the new criminal offence in circumstances where neither the tax evader nor the facilitator have actually been convicted themselves. This is because there may be circumstances where it is not in the public interest to pursue a prosecution at the individual level. For example, where the tax evader has entered into a disclosure agreement with HMRC and is therefore subject to only civil sanctions, or the facilitator is a whistleblower. Some concern has been expressed during an earlier consultation that this is unfair to the corporation, but the government has consistently emphasised that underlying that the new offence is about encouraging better corporate behaviour and governance in relation to tax, and has proceeded nonetheless. I'd now like to look at the second offence, which is the failure to prevent the facilitation of foreign tax evasion, and just to highlight a few distinguishing features of it. This second offence will only bite where there is some form of nexus to the UK. The legislation seeks to achieve this by providing that the offence will apply to all UK incorporated or UK-based corporations, but it will only apply to overseas corporations where the act or omission constituting the facilitation of the overseas tax evasion took place in the UK. Dual criminality is required in respect of both the foreign tax evasion offence and the foreign facilitation offence. Broadly, this means that the conduct which amounts to the tax evasion and to the facilitation must both constitute an offence under the law of the relevant foreign country concerned, and it would also amount to a UK tax evasion offence or a UK tax facilitation offence under UK law. As in relation to the first offence we talked about, both the foreign tax evasion offence and the facilitation offence must have been committed with the necessary knowledge or intent. Significant concern has been raised during the consultation period about the inclusion of this foreign tax evasion facilitation offence. Some stakeholders have commented on the additional level of complexity and the burden that it will place on corporations seeking to implement reasonable prevention procedures to comply with the legislation. Others have expressed concern on whether it is appropriate at all for the UK to spend its time and resources pursuing overseas corporations for their failure to prevent the facilitation of tax evasion in overseas jurisdictions, particularly given the practical difficulties that the relevant UK prosecuting agency will face in doing so. A further concern is that a corporation may find itself liable for the failure to prevent the facilitation of an offence in relation to the evasion of a tax which would not itself be lawful in the UK, for example because that tax is a form of extortion or is discriminatory. The government has sought to counter these concerns by including in the legislation a requirement for the Director of Public Prosecution to consent to any prosecution for the offence of facilitating overseas tax evasion, with such consent only being given where it is in the public interest to do so. HMRC has also confirmed that its preference will generally be for the jurisdiction which suffers the tax loss to take the criminal or civil response which it feels is most appropriate. However, where the authorities in that overseas jurisdiction are prevented from doing so, where the relevant body is a UK corporation, the government believes firmly that it should be able to take action itself. As a practical matter, though, HMRC has indicated that deferred prosecution agreements may prove a more effective tool to pursue in this space. Where the elements of the UK or foreign tax facilitation offence are proved to the criminal standard, and the corporation cannot satisfy the reasonable procedures defence, which I will come back to discuss shortly, the corporation will be criminally liable and subject to an unlimited fine. It is unclear at the moment what the maximum level of this fine could be. In the context of anti-money laundering and bribery legislation, corporate fines are in principle unlimited, but the published sentencing guidelines suggest fines of up to 400% of the harm caused by the offending conduct. It remains to be seen whether similar guidelines will be produced in the context of this new tax offence. There will also clearly be significant reputational risk for any financial institution or corporate which is convicted of the new tax offence, particularly given the current climate. Many corporations have already expressed their concerns about being seen to facilitate tax evasion. So, given this, how can organisations protect themselves? Where the conditions for the application of the offence are satisfied, it will be a complete defence for the corporation to show that it had in place reasonable procedures to prevent the facilitation of tax evasion, or to demonstrate that in its particular circumstances it was reasonable to not have any prevention procedures in place at all. The burden of proof in relation to the defence is on the organisation, and so it will be very important for corporations to retain appropriate and contemporaneous documentation in case it is needed later as evidence. Draft guidance has now been published for relevant bodies on the formulation and implementation of reasonable prevention procedures. The government has stated that it is mindful of the need not to overburden corporations with compliance. However, it clearly requires businesses to pay more than lip service to preventing the facilitation of tax evasion. Given this, the guidance is not prescriptive, but rather follows the principles-based approach that businesses should already be familiar with in the anti-bribery context. The question of what constitutes reasonable procedures will depend in all cases on the particular risks that the business in question faces. There are 6 core principles to which businesses should adhere in order to satisfy the reasonable procedures defence, and these are set out on the slides in front of you. The first principle of proportionality is absolutely key. In order to be reasonable, prevention procedures, both in their design and implementation, must be proportionate to the risk that the organisation in question faces, having regard to its size, the nature, scale and complexity of its business, the jurisdictions in which it operates, and the reliance which it places on third-party services providers. Secondly, there must be a top-level commitment towards the prevention procedures so that it is clear that the culture of the corporation is that criminal facilitation of tax evasion is not acceptable in any way. The senior management of a bank or a company should be visibly involved in and formally support the prevention procedures that are introduced. The guidance anticipates that senior management of large businesses and financial institutions will do so by way of delegation to and oversight of a committee in a way which reflects the practice which has been commonly adopted by businesses to comply with a similar principle which is applicable in the anti-bribery context. Thirdly, the corporation must carry out an assessment of the nature and extent of its exposure to the risk of its agents engaging in activity during the course of business to criminally facilitate tax evasion. The risk assessment should be documented and kept under periodic review. Relevant risks which should be considered include country, sectoral, transaction and business opportunity risks, as well as any risks arising from the organisation's own internal controls. Due diligence. The company must carry out due diligence on the persons who perform services on behalf of the organisation. A risk-based approach should be adopted so that persons performing services at high risk of being used to facilitate tax evasion are subject to greater due diligence. The fifth principle is that of communication and training. The organisation must ensure that its prevention policies and procedures are communicated, embedded and understood throughout the organisation. The government has emphasised that this communication must include a confidential means by which representatives of the organisation can raise any concerns about the provision of services which may be being used to facilitate tax evasion. Training for employees on the detection, prevention and reporting of suspected tax facilitation offences should be introduced, and the level of training should be proportionate to the risk based. Again, businesses should take some comfort that whilst all training should be appropriately tailored towards the risk of the facilitation offence, it is clearly accepted by the government that there is some scope for this training to be incorporated into the existing financial crime prevention training. Finally, the organisation must monitor and review the preventative procedures implemented and make improvements where necessary in response to any evolving risks. In addition to the general principles-based guidance, the government also recognises that it may be appropriate to introduce further sector-specific guidance, which can be designed by the particular industry in question and then endorsed by the government, and this has asked for stakeholder views on this issue. Finally, I wanted to run through some of the initial steps which your business should be looking to take now in order to prepare for the introduction of the new offence. Firstly, it is imperative for every business to carry out an appropriate risk assessment of whether its services or services connected to it are at risk of being used by employees or other associated persons in order to facilitate tax evasion. As part of this process, all relevant associated persons should be identified and due diligence checks should be undertaken. These checks should include the services the relevant persons are providing, the jurisdictions in which they operate, and the potential scope for the facilitation of tax evasion by such people. The contractual arrangements with third-party service providers, contractors, and agents should be revisited. Consideration should be given as to whether these arrangements should be amended to reflect the organisation's policies in relation to the facilitation of tax evasion. Safeguards may need to be added to enable the termination of a relationship in the event that tax evasion is identified. Existing policies and procedures in the anti-money laundering and bribery context should also be revisited. Again, consideration should be given to whether procedures designed to deal with the prevention of the tax offence can simply be incorporated into these existing policies, and if so, to what extent, or whether entirely new standalone procedures should be introduced in order to remedy any gaps. Some thought should also be given as to whether different procedures could be implemented to deal with the facilitation of UK tax evasion and the facilitation of overseas tax evasion, depending on the relative risks of both. Training for senior management, compliance, financial crime teams, customer-facing staff and other relevant employees should be designed and introduced. The training should enable staff to understand what tax evasion is, how to identify and investigate it, and how to ask questions of customers and other colleagues. As I've already mentioned, the organisation's policies relating to the facilitation of tax evasion should clearly be communicated internally, including in particular the procedure for whistleblowing. That was all that I wanted to say in relation to the new offence. I would also encourage you to watch the other two webinars in this financial crime series after this webinar has finished. These are also on-demand recordings. If you go into the resources tab on the left-hand side of your screen, you'll be able to click directly on the links to watch those webinars, which are on preparing for market abuse regulation and navigating cross-border investigations. Thank you very much for listening, and I hope you found this information useful.